Hi, everyone. This is Jason Barrack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. We last had him on in December of 2014. He is Mike Mish, as he is affectionately known, Shedlock. He's a registered investment advisor, representative for Sitka Pacific Capital Management, and he also has a very popular investing and economics website called Mish's Global Economic Trend Analysis. Mish, thank you for joining us again.
Hey, a pleasure to be back on the show, Jason.
Now, first, I want to talk about interest rates. This is something that I think Wall Street and the mainstream Keynesian economics and the people at the Federal Reserve, they had their mind made up. They're talking about raising rates sometime later in the year. But do you think the Federal Reserve is trapped, and can it meaningfully ever raise interest rates?
That's a good question. There's a difference between trapped, because I don't think they would ever admit that. In fact, I'm not sure they're bright enough to ever even realize whether or not they're trapped or not. But whether or not they will, let's put it this way. The data has been so weak. New home sales today, down 11.4%, down 15.8% in the South. Median home sale prices are rising. The Kansas City Fed report, manufacturing report, came out today, negative across the board. We saw factory orders decline 6 months in a row. Everyone tried to pawn that off on the weather. Well, I'm sorry, home prices or home sales rose last month and were down this month in the South, so that's not a weather-related issue. And I think a lot of it has to do with the strength of the U.S. dollar. Manufacturing exports are hurting. Europe is becoming more competitive. There's also a global slowdown in China. Our neighbor to the north, Canada, is struggling in what I believe is a recession. And I think U.S. GDP is going to come in the first quarter. I'm going to take a stab around 0%, and it wouldn't surprise me if it's negative. Now, Fed Governor Fisher came out and said that he thinks this is all transitory. Well, what if it's not? Is the Fed really going to hike right into a recession? It seems like they want to, if for no other reason that they promised the markets they will. But if economic data just keeps coming in as weak as it has been, I don't think they will. And if they do, it's a sign that they're, in spite of what they say, that they're concerned about very real asset bubbles in junk bonds, in equities, and we have the rebuilding of a bubble in housing, although it's not quite to the level it was at before.
Yeah, I don't think the Fed can really raise interest rates meaningfully. They may try a couple token attempts, of quarter-point raises here or there, but I think, like you said, they could. I don't think they really want to prick the asset bubbles. I think they believe they're 100% mentally committed to this wealth effect, using financial repression, quantitative easing, whatever program name, to boost the asset prices higher. And they still think despite there's a lot of empirical evidence, Mish, that says higher asset prices don't really benefit most of the people on Main Street, because most of the people don't own a really large stock portfolio, and they don't have all these extra real estate holdings, and they don't have a very large bond portfolio. But the Fed is still, I guess, committed to this wealth effect of sorts, because it thinks it'll benefit the economy and create a positive feedback loop with consumer spending and other things.
Well, it hasn't, has it? I agree with you. That's what they're thinking. But it hasn't, and it won't, and it can't. Fed's policies benefit those most who have first access to money. Well, who's that? That's the banks. That's the already wealthy. That's the people who own assets, who benefit from them going up. The average Joe on the street doesn't have assets. If he has any assets, it's a house, and more than likely he's underwater, break even on that thing, depending on how big of a mortgage he's got on it. So the idea, and look at what the Fed is doing here. Rent prices are going up, actually in some places quite substantially. The average interest rate, the average Joe is getting in his checking or saving account, it borders on zero. You got all the people on fixed income who are trapped earning 0%, trying to live off Social Security. So he's actually taking money out of the hands of the people who are most likely to spend it by what he's done. Net, the Fed's lost, I believe, in what they've done. And yes, it is financial repression. I've talked about that on 2 occasions, two lengthy interviews with Gordon Long on that very subject, financial repression.
Now, this transitions to something that you just put out a piece on, I think either this week or last week. It was on the pension plan crisis. Do you think the Fed is intentionally trying to keep these asset prices higher so these pension plans, that are like teachers' pension plans, et cetera, in different states, can get a higher rate of return? Because it seems these pension plans, in order for their members to get a good retirement, they've needed 7-8% returns per year, but they're only getting 1%, 2%, and they're having a lot of large investment losses in the most recent past.
Well, they had large investment losses in 2007, 2008, and the first quarter of 2009. Since then, it's been a one-way ticket up. However, if you look at the state of Illinois, in spite of over 200% rally, almost 300% actually, 666 to 2,000 on the S&P. Illinois pension plans, a huge number of them are average 39% funded, and the worst of the lot is under 20% funded. So, and the best one is only about 40% funded. So that's in spite of this rally. So what happens here if we get a 20% decline in the stock market? And I think we're going to get a 33% decline minimum, and 50 wouldn't surprise me in the least, based off of what's happened here. The question is, when does it start? That's really all we're talking about here. I've pretty much been, saying this for 2 years, and I've been pretty much wrong for 2 years. But the bigger the bubble gets blown, the bigger the exhale when it pops. And so we're just talking about the timing of it here. There's very few asset classes I like. I happen to like Russia. The average PE in Russia is like 6%, or PE of 6. I happen to like gold, but it's been out of favor for going on 3 years now. And I like Japan, and that's it. It's very, very difficult to find investment ideas that are worthwhile. And the average U.S. pension fund is not in gold. They don't care that it's an undervalued class, and certainly not in Russia. They're plowing into riskier and riskier things. They're plowing into the high-flying, stocks, because those are the ones that are performing the best. Well, great. They're also going to perform the worst when we get to the next downturn. And what does a pension plan do that's 40% underfunded, and all of a sudden, over the course of, say, 2 years, drops another 40%?
They go to Washington, D.C. or to their congressman, and they beg Ben Bernanke. They did beg Ben Bernanke, but now they go to Janet Yellen and they beg her to print more money to prop up the asset markets again. Yeah,
I don't think we're going to recover from the next crash like we did the last one. We had a crash in 2000. We had another one in 2007. I was actually stunned by the rally we've had in this last one. I think the next one is liable to look more like Japan. I'm not saying like Japan, but more like that, where stock prices go down and then just absolutely meander for years instead of completely falling to hell. Our demographics are a lot better than the demographics in Japan. But having said that, the possibility of a Japanese-like scenario is certainly not out of the question at all. And typically, at the bottom of a crash, people hate equities. They don't want to have anything to do with them. It didn't happen this last crash. We rebounded too far, too fast. People got back in, and now everyone's happy again. The stock markets, I think, are going to truly bottom when everyone is totally disgusted with them and just vows never to get back in them again. And what's that going to take? Another huge decline. I think one's warranted just on the basis of where things are. The 10-year smooth PE is at one of the three biggest bubbles in history. The 1929 and 2000 were bigger, but in some ways this one's bigger than the bubble we had in 2000, because the 2000 bubble was predominantly in dot-com stocks, in companies that had no earnings at all. Now we just got literally everything flying high. It doesn't matter. And the more junky it is, literally, in many cases, the more higher it's flying. So we're going to see an across-the-board collapse in asset prices, I believe. Just can't tell you when it's going to start.
Yeah, I think these pension plans, Mish, I think they're holding a lot of shale oil junk bond debt. And, these assets, and I'll use them in quotes, they were high yield for a while, and everyone thought that the oil price would stay high, including myself. I didn't see the oil price collapsing by 50% in only, X number of months since June of 2014. But now that the oil price is so far, a lot of these shale oil producers are underwater, and they're doing emergency capital raises. Their hedges are coming offline the next 6 or 12 months. They're on the phone calling the bigger oil producers, begging for a buyout at even a fire sale price. And there's going to be bankruptcies here, and there's going to have to be write-downs on these. I think there's over $100 billion worth of shale oil junk bond debt that's out there in the markets, and that's not even counting the derivatives on those. And I don't think the banks that issued, the shale oil junk bond debt, I don't think any of them have any near as much money as they need for loan loss reserves, and I don't think there's been any real write-downs of this shale oil junk bond debt yet either.
Absolutely, across the board, I agree with you. And to that, I'm going to add, we've lost over 100,000 jobs, in that sector. And we saw that actually turn up again in the report that I mentioned today, the Kansas City manufacturing report. That district happens to cover, some oil-producing states, I believe. So we're seeing weakness across the board. And these aren't just like 100,000 jobs, part-time jobs that we lost at Applebee's or McDonald's. We lost 100,000 high-paying jobs. And it's just starting, because the industries that serve these oil producers are going to take a hit. And that's what actually came out today in the Kansas City manufacturing report, in a couple of the comments, along with the strengthening of the dollar hurting U.S. exports.
Yeah, I've heard the same thing. I don't know if you're friends with Kerry Lutz, but he knows a couple geologists up there who have worked in the Bakken for a while, and they just went on unpaid leave. They weren't fired per se. They were used nicer terms. But his contacts up there in the Bakken, North Dakota, said there's at least 250,000 direct jobs lost. I did an interview with Kerry Lutz. He interviewed me a couple days ago this week. I could send you the link later if you want, or I could give you his contact information if you want to talk to him about it. But that's just the direct jobs, and then there's the multiplier effect from those direct jobs, like a factory job. So there's the restaurant owners, there's the bartenders, there's, the people at the Walmarts, the people at the stores. So there's got to be, I'd say at least double, maybe triple or quadruple the amount of indirect service sector jobs that are all tied to those higher paying oil jobs. Yes.
Here's a couple of comments that came out today from the Kansas City Fed. The durable goods sector isn't very good. We are reducing headcount and spending where possible in order to withstand this phase of the economy. Another comment. The strong dollar is good. It's driving down commodity prices, but it's bad because it's making us less competitive globally. We're making fewer products, making more money on them, but it's been bad for our employees because we have less work and fewer employees. Overall, it's a negative for us. And the third comment that came in, the strong dollar is undoubtedly creating more opportunity for foreign manufacturers. The impact has only just begun to be felt in our bookings. Only just begun to be felt. And that kind of echoes my sentiment. And, I've been watching these economic reports come in weaker than expected for 6 months in a row. They've tried to blame all of this on the weather. Well, you can only blame so much on the weather before that excuse gets pretty tired. And new home sales going down today certainly was not weather related. This Kansas City manufacturing report that came out today, not weather-related.
Now, you talked about a strong dollar. I want to talk about currency wars. Since we last spoke, the Swiss depegged from the euro. I guess the market found out about that in advance, and there was an enormous, revaluation of the Swiss franc. Are you expecting in the near future that all currency pegs are going to come off, or is a country like China that's pegged to the dollar at a certain fixed exchange rate, are they going to repeg at a different exchange rate, or are they ultimately going to have to take the peg off altogether?
That's an interesting question. I don't know the answer to that in regards to China. I think they want to get rid of their peg, but I also think they want to lower yuan. And the Chinese economy is not in good shape. And here we have the U.S. screaming, here about the loss of exports. And I'm surprised we're not screaming even louder here. But this time, the next time they're going to be whining about losing manufacturing, not to China here, because they're pegged to the dollar, but to the euro. In fact, German exports are going up right now. Spanish exports are going up. So we have this global competitive currency debasement, but Washington likes to bitch at China. So if China lifts its rate and the yuan sinks, which I think is a reasonable possibility, actually, you'll see the U.S. bitch. Another possibility is that China just revalues the yuan lower, saying, okay, the U.S. dollar is too strong. Let's look at it from China's perspective. China pegged to the dollar, the yen has collapsed, so China's losing exports to Japan. How well does that go over in China? Not very.
Not well at all. They don't like the Japanese very much. They trade with them, but they're not on friendly terms.
Yes, that's correct. So China is not at all happy about Europe, not at all happy about losing exports to Japan. So it wouldn't surprise me at all if in the near term Japan let the yuan floated, say, in a wider band. And that wider band just happened to be lower versus the U.S. dollar.
Yeah, everyone's Keynesian. Everyone's trying to gain an export advantage through a devalued currency. It's, mercantilism. I think I've heard that China actually plans in the next 12 months or so to devalue the RMB by about 50% against the dollar. But I'm sure there's backlash. The U.S. government, the U.S. Treasury Department, and the Federal Reserve are trying to get China not to do that. But I think China is kind of planning on doing that because I don't think anyone, Mish, whether it's the U.S., I don't think anyone wants a strong currency in this environment right now.
No one does. The Fed has put up with it. It'll be interesting to see what they think, what they say, what they do. Actually, that'll be the interesting one. If I'm correct that the U.S. is headed back to recession. And actually, I think there's a 25-30% possibility right now that the U.S. is already in recession. The next GDP report is going to be kind of interesting. Of course, the NBER, that's the official arbiter of recessions, they don't depend on their requirement is not 2 consecutive quarters of declining GDP. Rather, they look at industrial production. They look at all kinds of other things. So, and the declines in factory output and in some of these things, credit decline. Oh my gosh, I talked about that, Liz. For small businesses, we're back in a credit crunch. We've not seen this since 2009. So a lot of factors indicate to me we're already in recession. We'll just see whether they're transitory or not. I think they're not. The Fed believes they are. One of us is wrong.
I think the Fed's wrong. I'm friends with a good number of accountants, and we just had tax day, And we had the Democrats and all the politicians talking about, mostly the Democratic politicians talking about how the Obamacare exemption, right, would not cause any problems for small businesses. But that's not what I heard from my accounting friends when they were doing their taxes for small businesses in the Washington, D.C. metro area, which has, 3 of the 5 richest average median family incomes counties in the whole country. So I think Obamacare and then all these other problems, more inflation in the global supply chain and in higher commodity prices for food and energy, energy did take a break. I think all of these factors together, I don't think they're transitory. I think, once inflation's in the global supply chain, these companies, whether it's Kraft, trying to manipulate the wheat market or these other things, they're looking for ways to protect their margins and raise prices or reduce the portion size for consumers with shrinkflation.
Mm-hmm, mm-hmm. Yeah, we're seeing that on food. Although recently I do the shopping in our house, and food prices had been going up. Actually, the last time I shopped, it looked like to me that prices have stabilized. In fact, come down. Something that I rarely see, but we had chicken, beef, and pork all on sale at the same time.
Maybe they were loss leaders. The grocery stores.
Yeah, normally they do one. For instance, chicken legs were on sale for 99 cents a pound. Chicken breasts were on sale for 99 cents a pound. That's a good price. Pork chops, center cut pork chops were on sale for $2.49 a pound. That's a reasonably good price. In fact, that's a good price. What was the other one? Beef has been higher generally, but this was the first dip in beef prices that I've seen. So, and the weird thing is, this is all good news, but the Fed ain't gonna like it. They don't like falling prices.
Yeah, they don't like falling prices, and they don't like consumers getting more purchasing power, more bang for their buck.
Yes. It's pure madness. The average guy on the street welcomes falling prices. And this whole notion that people hold off buying things because prices are falling is nuts. Well, you buy food, because you need to eat. You buy gasoline because you need it, whether it's falling or not. I don't believe you go out and delay a purchase of a coat if you need a coat just because prices are falling. However, if the price of an appliance, a microwave, if you're thinking about buying a new one and the prices keep going up, a lot of times you decide, I'll just hold off on this because the price is going up. Instead, they've got it asked backwards. All of a sudden, you're thinking about buying a microwave, and you say, well, no, I'll hold. This one's still good. And all of a sudden, there's a sale out there. So I think it's the opposite of what they say.
Yeah, I agree. I think Keynesians have almost everything completely asked backwards.
If they think they've got a good price and a good bargain. I don't think they buy. I don't think they hold off because prices are going down. Maybe at the margin there's a little bit of that, but it also works in both directions, like I just said. So, and the Biz even came out. Bank of International Settlements came out, I think it's 2 or 3 weeks ago, and they did a study on consumer price deflations, and their result was they're not harmful at all. Very peculiar. The Bank of International Settlements, that's the banker's bank, actually, if you want to look at it in those terms. They actually concluded that there's no harm by falling consumer prices, which is a subject that I've harped on over for the last 3 years, that it's an asset bubble burst that's harmful, like what we had in 2000 when home prices burst. And in order to prevent consumer prices from dropping, the Fed has blown one of the biggest asset bubbles in history. When that thing pops, we're going to see the very destructive kind of deflation that they've tried to prevent, because it's going to dry up the demand for loans, and it's going to destroy the value of the loans on the books of these banks because they're all based on inflated asset prices. Banks are going to be capital impaired once again, just like they were in the housing bust.
Yeah, most of the Keynesians, like PhD economists, I've spoken to some former Fed officials that I've spoken to, they don't consider asset price inflation inflation.
They don't.
So they consider, they only look at consumer prices at the CPI. So, if the stock market's doubling, if the bond market's going higher for little or no reason, no fundamental reasons, if the real estate market's going up, they don't consider any of this inflationary. But if you read von Mises or Rothbard, any of their books, and they mention this, they say normally the first place the inflation goes, Mish, is into the asset prices
Absolutely.
first. Normally before it goes into the consumer price.
Absolutely. The one exception to that was the stagflationary recession in the 70s, and we had another one maybe in the early 80s. And the curious thing about that is Keynesian belief at the time was such that Keynes himself believed that it was impossible to have recession and inflation at the same time. And that should have destroyed those stagflations in the 70s and 80s, should have destroyed, blown Keynesian theory right out of the water right then and there. Somehow it didn't. It's amazing how these guys can cling to many times disproved economic theory.
Yeah, I completely agree. Keynesian economics should have been completely destroyed and obliterated with stagflation, with the Phillips curve saying higher inflation, higher unemployment, or people, part-time jobs, that the Keynesians said, there had to be wage growth for inflation, and the stagflation completely disproved that.
Yes.
But then you have, economics academia where these professors have full tenure, and, their bad theories, they don't get really called out on it because they have full-time, high-paying jobs, and pretty much unless they commit a felony, they really can't lose their job.
That's correct. So we have academia agreeing with the Fed, and you know how you get appointed to the Fed? Well, you write publications and articles that support their viewpoint. That's how you get on the Fed in the first place. So it's a good old boys network that just spawns belief in ludicrous theory.
Yeah, I completely agree. I'm not a fan at all of Keynesian economics. I like reading Austrian school economics. That's my favorite. My next question for you, Mish, is you cover a lot of trends. So whether that's technology or currencies or economies falling and rising, what trends are Wall Street and the American mainstream media totally wrong or clueless about?
Well, valuations. With every bubble, you hear the same thing over and over again. In 2000, we heard, click rates, even though these companies had no earnings. In 2007, we had the theory that home prices never decline nationally, that home prices is all local, and that was disproved when home prices fell nationally for the first time ever. And now they're back at it again. They're justifying that they're saying, well, stocks are good compared to bonds. Well, what if neither is any good? The idea that you have to be in one or the other is one of the main economic foolishnesses, or in comparing stocks to bond in the first place is a ludicrous idea, but that's what they say. So they say stocks are cheap compared to bonds. Well,
modern portfolio theory. It has to be, you have to have most of your assets, right, in stocks or bonds. That's like what most of the industry and most of the academics teach, right?
Yes. It's a self-serving model, if you would, because that's how these guys get paid. So, and they also don't get paid on cash. You have to be in the market, invested in something for these guys to be collecting their fee. So that, by the way, is the origin of you can't time the market. You have to be, in the market 100% of the time, to get all the advantage, is because these guys don't collect fees if you're not in the market. So that is, another one of these, theories that is just wrong, but never ends, because I don't know why, but people fall for this thing hook, line, and sinker every time, Jason.
Well, it's because they're all taught the same stuff in academia, and all the stuff's repeated on the mainstream media. I mean, the other alternative viewpoints are hardly even given a voice. I was in MBA classes. I took MBA classes for a year. I didn't have a business background initially before I started reading and learning on my own and working in financial services. And when I was in MBA classes, there wasn't even any alternative, Austrian school economics books in our business library. So, if they're only going to teach one set of theories and say, this is it, this is how the world works, even if we screw it up, it's capitalism, it's the free market's fault, even if it's, the fault of the central planners, the Keynesian academics pulling the liver, eventually, they're either going to destroy the currencies, or people are going to wake up and they're going to be stuck with a lot worse lifestyle, or the American middle class is going to be destroyed as a consequence.
No, the middle class is clearly being destroyed right now. And the weird thing is they don't even see that they're the cause. Janet Yellen moans about, income inequality, and you know what? She ought to look in a mirror to see the cause of it, because the Fed is hell bent on getting prices to rise in an inherently deflationary world. Demographics are unfavorable. People are negative. They need to be saving for retirement, not spending money. Technology itself is inevitably deflationary. Robots and robotics and computers, the internet itself, all this stuff is inherently price deflationary. Yet the Fed comes along and says, we're going to try and force prices up. And they didn't. Instead, they forced asset prices up, creating a bubble, as we said. And they also drove interest rates to zero, so that senior citizens living off fixed income are getting nothing on their cash. And they're losing money, certainly on Social Security benefits that they do collect, or any pension benefits they collect. So we have all of these policies that are absolutely ass backwards. Yellen moans about income inequality. Well, it happens because we inflate the prices of stocks, and the CEOs get paid based off of how well their stock price is doing, and they don't even see the connection. They don't even see themselves as the cause of this income inequality.
And we also have, to add to your points there, Mish, about income inequality, she's letting her political slant, her Democrat progressivism get in the way. The reason we have income inequality is because the real economy, Main Street, is not creating those full-time, high-paying jobs from entrepreneurs and small businesses. We do have some, technology jobs that are being created. Most of the oil jobs that were created are being vaporized now. But technology does create some high-paying jobs, but also destroys a lot of old jobs. So, we're not having the situation here because of rules, regulations, taxes, red tape, higher minimum wage laws, those things, where a small businessman who has the ability to look at his market and say, I can go out and grow double my business in the next 7 years or something, and he's scared to make those investments because of all the rules and taxes that government can put in place that, even if he can grow his sales, that he might not be profitable and he's risking bankruptcy.
Absolutely. That is particularly true in places like Illinois, California, where we have net migration to places, say, like Texas, Indiana.
Well, my last question for you, Mish, and then I'll let you go, has to do with this John Corzine news. I'm pretty disgusted when I see, he should be in jail. He's obviously a big-time political fundraiser. He's a Wall Street crony. Are you disgusted that he's very close to raising a lot of money again and starting another hedge fund?
It's not surprising. How can you say it's surprising? I mean, look at the people that they've gone after. I mean, other than Bernie Madoff, and actually they didn't even go after him until until he went under, until the company went bankrupt. Before that, we had all kinds of of people queuing the SEC that Madoff's returns were not real, they couldn't be real, that he was cooking the books. They ignored all of that until it blew up. Instead they focused on Martha Stewart. And, and what a joke. So, look at, what the sect does and what they say and who they're targeting. And, it's all of this stuff is just part of the sleaze of what you can get away with. Look at look at Jamie Dimon. Look at the CEOs of all these financial companies. Look at someone like the CEO of Countrywide Financial, Mozilla. This guy cashed out $1 billion worth of stock options in Countrywide Financial while driving the company into the ground and assets in the company to zero. And whatever happened to him? Nothing.
Yeah, didn't he escaped the country, right? He's somewhere not where he can't be extradited, or is he still living in the United States?
He's in the U.S. He's safe. He made his billions, and his parachute was such that even if he is fined, the company is going to pick up the tab for his fine. That's what these parachutes look like nowadays. Again, who's responsible for all of this? It's complacency in Wall Street. It's complacency, dare I say it, by the Republicans. It's just complacency across the board. And we're seeing it again in the trade agreement that Obama negotiated. This is a horrendous deal. It's a backdoor deal for more loss of jobs, and it doesn't even open up free trade. Obama is pushing this trade deal, this Trans-Asiatic trade deal, because he gets something he wants out of it, which is more environmental, more global warming bullshit. And the Republicans say, okay, well, we'll go along if you do this. And if you look at who's being screwed, it's the average consumer, where no one is being protected by what's in this. So, yeah, it's disgusting across the board, and it's not just one political party. Everyone, for one reason or another, is bowing, over to Wall Street. Meanwhile, banks can create money out of thin air and lend it out, a process that is without a doubt fraudulent, and everyone sits back and acts as if this is normal.
Yeah, I'm just amazed that it's gone on this long, that they've been able to keep the game going, but I guess so many people are still asleep. I think you brought up a very valid point there about debt-based fiat money and how the banks can fractional reserve lend and just create the money out of thin air. I think that's created, a humongous lack of morality throughout the levels of society because, in capitalism, normally there's bankruptcy, there's failure. Yes. People are more prudent with their risk-taking, or at least most people are in the past, compared to now, whereas, you have a banker now and or some of the other examples you gave, just a couple of minutes ago. And those guys, either they would be in prison in the past or they'd be sued and lose their pants by everyone, and they wouldn't have taken half the risks that they've taken.
Yeah, now they've got the implicit backing of not only the Fed, and they strive to get it from the government. That's what's going on here. And then, they have the gall to whine about income inequality when they're the very source of it.
Do you think the next global financial system, as China, Russia, they start to do more partnerships, more bilateral trade agreements, more currency swaps, as China gets more members to join the Asian Infrastructure Bank, do you think this is going to slowly put this this corrupt, immoral global financial system, it's going to slowly reduce it?
No, it'll just change it. I hear a lot of talk that, the yuan's going to be the next reserve currency. Well, I don't know in what time frame. My I always respond with a bit of skepticism to that. And in fact, I respond with a big, not skepticism, but with a big, it ain't ever going to happen. I don't want to use the word ever, but China clearly doesn't want it. If they wanted it, they would be floating the yuan. Here you got all these people, praising the yuan when China had, in spite of all its problems, the U.S. has the biggest, most liquid bond markets in the world. China doesn't have one to speak of at all. It's still got a command economy. If the Chinese central government says build more houses, well, guess what? More houses are built. At least that doesn't happen in the United States. We encourage humane behavior based on monetary policy, but at least it doesn't come down as a dictate, build more houses. The state-owned enterprise system in China is an absolute disaster. You get cities where everyone that are entirely vacant. You've got airports, bridges, everything, malls that are vacant or unused. So, this whole idea that China is soon going to replace the world when they don't float the yuan, there's no political freedom, there's no economic freedom really. You can't say what you want in China. I said if I was having this discussion here in China on a Chinese network, I'd be arrested the next day. So at least here in the United States, we can have this kind of conversation where we couldn't have it in China, and yet all these people, think that China's going to, replace the U.S. I think it's nuts. And on top of it all, China doesn't even want it. There are problems with having the reserve currency. And I've talked about that, and maybe we should come back and discuss that another time because that's a lengthy topic in and of itself. But China probably doesn't even want it. It's debatable whether the U.S. even wants it here now. So, and if you look at how every country's trying to, trash their currency, maybe you can at least see it in that. So, so yeah, just because China is big, is huge, is growing, there's going to be more trade from China, but that doesn't mean it's about ready to, replace the U.S. as the top economic power. We're at least anytime soon. Let me put it this way: we're at least a decade away, and it wouldn't surprise me if we're 4 decades away. The China miracle has a way of China miracle theory has a way of reoccurring every couple decades or so and then collapsing. And, maybe we don't see the collapse this time, but in the U.S. it's not.
Yeah, and there was a Japan miracle theory before the China miracle theory.
Yeah. Exactly. Japan was going to take over the world. Now everyone believes that China is. And for a brief while, everyone thought that the euro was going to. Now, bear in mind, I think the end is going to come, and it's going to come by a currency crisis globally. Maybe it starts out in the yuan, maybe it starts out with the yen, maybe it spreads to the yuan, maybe it starts in Europe and spreads. I think a global currency crisis is coming based off of all the idiotic things that central banks have done. But, that doesn't make China necessarily the beneficiary of any of it.
Yeah, I agree. I definitely see a global currency crisis coming. And you said earlier in the interview you were surprised that asset prices have gone up this much. Actually, since 2010, 2011, the more I studied the Federal Reserve's white papers and the papers that Ray Dalio put out, and the more I studied Austrian School of Economics and read von Mises and Rothbard, I wasn't surprised at all. It just seems all these central bankers, Mish, they're just determined to not have anything in deflation, as beneficial as it is, and they're willing to cut off their nose to spite their face. They're willing to create really bad stagflation. They're willing to create enormous asset bubbles. They're basically willing to destroy their currency just so that way they don't have deflation.
Yep. That's pretty much what it boils down to. One of the reasons why here now I've got a significant portion of my assets in gold and in gold miners. I think it's just an eventuality waiting to happen. I also like Russia. I also like Japanese equities, not because I like Japan, but I like Japanese equities hedged against the yen because I think that's another country out to destroy its currency, and its stock market is lagging the U.S. here. So that's another bubble they're trying to reblow, and one that I think is likely to succeed. So anyway, I guess that's it for me, Jason. Those are my I'll leave that with my three investment ideas there. Yen has Japanese equities, Russia, gold, and gold miners. Actually, that's four, I guess. So a pleasure talking to you, and people can find me. I talk about this stuff actually several times every day, 7 days a week, nearly. Just do a Google search for Mish, and you can find me.
Okay, great. Well, thanks again for your time, and I definitely want to have you back every couple months. I really enjoy our discussion.
Pleasure to be back on. Thanks, Jason.